Blockchain Show is a podcast that demystifies cryptocurrencies and distributed ledger technology.
Welcome back to the Blockchain Show, where we explore the latest trends and insights in the world of blockchain technology. Today we've got a special guest joining us, Emmanuel Daniel, global thought leader, entrepreneur, and author. Emmanuel brings a wealth of knowledge and expertise in the future of finance, and I'm thrilled to have him here to discuss the financialization of everything and its impact on our world. So let's dive right in. Welcome, Emmanuel.
Great to be on your show.
It's a pleasure to have you here, Emmanuel. If you wouldn't mind introducing yourself a little bit more to the audience.
I'm the founder of something called the Asian Banker back in 1996. Over a 30-year period, I built a business that now transcends all of Asia, much of Africa, much of the Middle East, the banking industry. And as I did that, I got to know lots of key people in the US banking system. And so I come from the traditional banking world. A few years ago, I started writing a book on the future of finance, and I figured that I had to wrap my mind around decentralized finance and how that was going to change things, if at all. And as I did the research on that, I think I could see how decentralized finance will become mainstream at some point. So I published my book in September of last year, and it's part conceptualizing the fundamentals of decentralized finance in a way that traditional bankers can understand, and then taking stock of everything that traditional bankers took seriously and considered to be core to their business. And then from there on, trying to project how the industry will evolve.
Yeah, that's definitely a topic that it's been a hot topic, with the whole scandals in the last year, which is unfortunate. I think it's kind of part of human nature to see these kind of things happen. And I really don't want to see that overshadow the potential benefit to humanity. What's your opinion on the space in the last few years, particularly since you've been working more with blockchain-related technology? Have you seen any differing opinions, or maybe you could give us a more positive outlook than some people might be hearing in the news recently?
Well, the one thing I can say, and I go back to what I've written in my book, which is that there is a lot of noise in the industry. I think there are lots of things about traditional finance that the crypto people don't understand, and there's a lot of things about crypto that the traditional finance people don't understand. The things that the crypto people don't appreciate about traditional finance is that that traditional finance is essentially the balance sheet. And I think that when you look at all that's happened to Silvergate, to Silicon Valley Bank, Signature Bank, the story is entirely on the balance sheet. And then on the balance sheet, something that I've been challenging traditional bankers was to look at the part of their business which they considered core, which is the deposit business. And I said to them, look, something's happening to the deposit business that it's not going to look the same in the future. The more digitized it becomes, the more difficult it will be to hold it together. And guess what? Silicon Valley Bank and Signature Bank, they were victims of being very successful on the deposit front, and then not being able to hold up the asset side of the business, investing in long-term bonds which lost its value because interest rates were on their way up. But it's not just that; it's the fact that the deposit business had become increasingly digitized. It became very easy for depositors to do a bank run. You don't need to queue up in front of the bank anymore. You just go onto your laptop and try and withdraw all your money quickly, and that doesn't give banks time to respond. And on top of that, when we think about digital finance, we're thinking about people who want to use their bank accounts to access a whole range of digital, ecosystems, whether it's payments, gaming, stuff like that. Things that crypto is now increasingly more useful than digital banking account. But I think the messages have got mixed up because the traditional bankers think that it's the banks with any form of relationship with the crypto world that have got into trouble, and that's not true. They got into trouble because the deposit side of the business was not managed properly on the risk basis and on the balance sheet. Then you look at what's happening on the crypto front. Lots of good stuff, the stable coins, decentralized finance, that can be ported over into traditional banking, but the traditional bankers don't want to look at it because, they think that anything crypto is bad news. And traditional bankers have this opinion that, blockchain is good, but crypto is bad. And you can't have that opinion. It's like, going to any religion and saying that, Jesus Christ is good, but the crucifixion is bad, something like that. It's all part and parcel of the package, that they needed to take into account. And then, the way in which the regulators have been dealing with the players, that the regulators haven't figured out how they want to regulate crypto. They don't even know how to define crypto. And on the other hand, they've been protecting traditional bankers, to an inordinate position. Like what happened in the Credit Suisse story was that they protected the shareholders, ahead of the bondholders, which they said they wouldn't do after the 2008 crisis. And so you've got a lot of confusion in the marketplace right now. When you add it up together, you need to, we all need to figure out how this is going to carry through, into the future. The good news is that that the lack of integrity in traditional banking will be filled. The void will be filled by new technology as it evolves. The interesting thing is that all that's happened in stable coins with Sam Bankman-Fried and so on, the technology itself hasn't buckled. The technology itself has been proven to be robust. It's possible to track all transactions, with integrity right through the whole process. And when you look at what happened on the balance sheet of Silicon Valley Bank or Signature Bank, there are elements of decentralized finance that could be applied to the treasury function in traditional banks, if only they bothered to look up and figure out how to apply some of these tokens and algorithms in order that they can manage their balance sheet on a daily basis. And then when you look at what the Bank for International Settlements is saying, it's saying that crypto is bad, but it's already laying the foundation for crypto to be accepted into the balance sheet of central banks, corporations, how much hedging that they are allowed to do, and all of that. So they're building the roadmap into eventual acceptance of crypto over time. So the thing is that everything that we see right now may sound confusing, but when we peel the onion, I think there's a roadmap being created right now for the convergence between traditional banking and crypto.
That's fascinating. I've heard a lot of people who probably don't know what they're talking about, but maybe kind of comparing these recent bank failures to 2008 financial crisis. And do you see any similarities? And this time around with blockchain technology being present, which is kind of fitting because that was part of the reason it was the Bitcoin white paper was made, was because of the 2008 financial situation. What's your take on that observation, if you don't mind?
Something I say to traditional bankers is that the banking crises that we have seen since 1971, when the value of the dollar was depegged from the price of gold, was that every crisis became increasingly ephemeral. So the 1984 crisis was about the value of actual mortgages on the balance sheet of community banks in the US. The 1987 crisis was banks starting to fund securities. And there was, Black Monday and all that. And then in the 1990s, when you look at entire countries getting into trouble, Mexico, and then the Asian financial crisis, a lot of that was on the perception of the ability of countries to make their, banking obligations. And then by the time you reach 2008, that was a crisis, triggered by the value of derivatives sitting on the balance sheet of investment banks. So that was very far removed from the 1984 crisis, when it was the value of actual mortgages is set on the balance sheet of banks. And then you reach the 2023 crisis, and it looks very different because, again, it's on perception of an intangible asset which does not even sit on the balance sheet of traditional banks. So there's a pattern here that's developing, which is that financial crises are becoming increasingly ephemeral. They're becoming disconnected with any form of underlying assets. And therefore, the mechanism required to deal with these crises are changing. There is no underlying asset that you go out to save that governments go in and provide capital to rescue. You're actually dealing with perception more than you are dealing with any form of underlying assets, and this is going to get worse as time goes on. Then you ask, what is the underlying asset that sits on a banking balance sheet, and you realize that the global banks make more money today from their trading assets, from their treasuries, and from their derivatives than they do from traditional banking. So when we take stock of how the balance sheet of traditional banks have changed over time, we begin to appreciate the nature of crises. The second thing that we need to take into consideration is that the countries that eventually make decisions that fundamentally changes banking and financial services are not necessarily the countries that are in control of their banking systems. It's countries that desperately scramble to save a situation. So when you think about the countries that have embraced cryptocurrencies right now, if you take El Salvador or Venezuela or any of the other countries that have sort of made crypto part of the economy, it's out of desperation. And then when you think about countries that will eventually allow crypto into their economies, it'll be countries that will need to export debt more than any other country. And actually that one country which has been very good at exporting its debt and needs to do it in a digital form is the United States. So I look at all the debates taking place in the US today. They are very similar to the debates that were taking place between 1945 and 1970s, which was, it's very important to hedge the price of money against the price of gold. And then on one fine day in 1971, President Nixon goes on TV and says, you know what, we're not going to do that anymore because we can't afford to. The US is at a point in its history where it's now got more debt than it has the ability to generate GDP. The GDP of the US is $21 trillion. The total debt of the US is now about $30 trillion. And it's going to increase over time. It has got no ability to rein in the debt. And the reason the US has been able to export its debt is because the trust that the rest of the global economy has on the US economy. And because of that, I think that in the digital world, the US needs to extend that ability going forward. And so I have a proposition here, which is that it's that the future of finance is actually dictated and shaped out of necessity rather than out of purpose. And so that helps me map a lot of the discussions that take place, whether it's in the Congress in the US or regulators anywhere in the world.
That was really well said again. Man, it's just so amazing to me how everything keeps working. And you have such a good grasp of the history of finance in this country and on the global scale. I wanted to ask you about the possibility of a centralized digital currency. Heard rumors about at the Federal Reserve level, what that might mean for us. Is this a good thing? Is this a bad thing? Also, if you wouldn't mind maybe sharing how the technology associated with blockchain could possibly help us in this situation.
You must take stock of the fact that I come from traditional banking. So anything I say is predicated on I needing to be convinced first before I propose this to traditional bankers. The thing about central bank digital currency, very interesting, is that I spent a lot of time in Beijing, in China. In the last 1 year, I visited with the governor of the central bank in various countries that already have central bank digital currencies live in their respective economies. I've also spoken to governors of central banks that have tried central bank digital currencies and then went quiet. I was very curious about why they went quiet. And when I met the governor, I asked him this question. And the feedback that I've been getting is that the countries that have gone live with central bank digital currencies and the ones that are piloting CBDCs extensively can't see it going fully live and making an impact or replacing digital money that sits on the balance sheet of banks. In other words, the economies that already have digital banking as part of the economies, all of Europe has that, the UK has that, several countries in Asia have got very well-organized digital banking infrastructure, and China also has that. Digital money works just fine. Central bank digital currencies is a solution looking for a problem. And getting entire populations to make that transition to central bank digital currencies, even central bankers don't appreciate the amount of work that is involved in making the transition, the amount of marketing that is involved in forcing the economies to make that transition, and the benefit it provides to the banking system. In fact, all of them say that yes, if we organize and we create central bank digital currencies, it actually bypasses the traditional banking industry, but we insist on it being disseminated through the traditional banking industry. Then you ask them, why do you need to do that? You're creating an unnecessary distribution network. And on top of that, of course, in the US, if you put out a poll right now, the general sentiment is that no American trusts the state to have data on themselves and to be able to track how they spend money. So then you ask, why is it that the central bank, the Federal Reserve Bank, is so determined to introduce central bank digital currencies? And then when you look at the discussions on CBDCs in the BIS, which is the Bank for International Settlements, the BIS is a very interesting platform in that it brings together all central banks around the world And it surprises me, for someone who has been following the BIS for many years, how central bankers generally get into agreement with each other as to what the next best thing is. For example, central banks around the world agree that their mandate, their job, is to keep inflation within a 2% range in terms of changes, and that's a concept, an idea, a construct that was created by the central bank in New Zealand many years ago, and somehow it became popularized. And today, even the Federal Reserve Bank, gives itself the job. In other words, it's a job description that the Federal Reserve Bank gives itself. It's not necessarily given by the state to keep inflation within a 2% margin. And I see that the central bank digital currency concept is something that's been popularized between central bankers, devoid of any feel of the ground or mandate given by the population. And then making it work is another problem, which is to get the population to make that transition. And the pushback from the traditional banks is severe. Whether it's in the US or any other parts of the world, banks make more money when you swipe a credit card, and they actually make profits from those transactions in the transaction fees, in the credit that's generated, and they make no money at all when you introduce a central bank digital currency. And so the banking system is going to be pushing back the central bank in making CBDCs work. So just from a practical point of view, from the way in which the industry has evolved, I don't see central bank digital currencies taking off. Now, then there's the other side of the story, which is what's happening on stable coins. Yes, there is a problem of governance, and yes, there are bad actors in the whole crypto world at the moment. But something that bankers don't appreciate is the amount of energy that goes into any form of crypto. You take Solana, you take any of the swaps, the Sushi Swap, Uniswap, and look at the number of programmers that have devoted their time. It runs into the hundreds of thousands of programmers willing to build applications around any of the crypto assets there are in the marketplace. There are almost none in central bank digital currencies. And then you look at what the central banks have been doing in the last 2 years. They've been running behind the developments taking place in cryptocurrencies and trying to keep up with the applications that are being created, whether it's liquidity creation, interoperability, and DeFi applications. So I see a world where CBDCs will just struggle to just keep up with the developments taking place in cryptos. Now, something I say in the book is that I can see a world where every bank in the world will want to compete on issuing stable coins of their own. And the reason I see that is that, as I said at the beginning of this conversation, the deposit business of the banking industry is under examination at the moment. It's the banking industry never imagined that the deposit business will cause them trouble, as it has, for the few American banks and now the European banks, and over time, the deposit business is only as good as the application in the digital world. Whether it's to pay for things on platforms, for gaming, for virtual reality, all the stuff that is coming on right now, and banks are the best place to create the governance and the structure for issuing stable coins as a value add to the traditional deposit business. Now, nobody in the banking industry would believe me right now, and some would disagree with me. But I want to put it out there and then watch what it will take to get there.
Yeah, it's very interesting. Very interesting. I have respect for the banking system that as it is. I understand it's complicated. It's taken a long time to get where we are. It's helped us a lot. But if you had the opportunity, let's say, as a thought experiment, to design a banking system to your specifications, what would you like to see change, and what do you think would be best for humanity, in the coming future?
If I put my finger on the one thing that distinguishes or defines banking today, and is being threatened by decentralized finance, is the intermediation business. The very need for there to be an intermediator, between two parties transacting with each other. And to be honest, that's a function that seems to not be going away. Even in decentralized finance, it's not as decentralized as we think it is. Any developer of a platform or a token becomes an intermediator themselves immediately. They provide the liquidity, they provide the platform, they are the exchange, and so on. Theoretically, you and I should be able to transact with each other directly, without an intermediary. And there should be any number of tokens that can enable us to transact with each other, regardless of the tokens that each of us generate. But that world hasn't come about yet, and then the question is, will it ever come, to fruition? So I say something in my book, which is that Adam Smith said that the small business owner is the most efficient form of business there is, because he keeps his cost to himself. He's the producer and so on. But from Adam Smith in 1776 to about to whatever has gone on to this day, we see that it's the big business that has been successful. And there was an economist called Roland Coase who said the reason that big businesses dominated, the economy in a way that Adam Smith didn't like to see and didn't project was that there was an asymmetry of information between the parties. So a small business owner does not fully grasp his own cost base, whether it's cost of labor, cost of natural resources, and how he could arbitrate that, whereas a larger business, a big business, had control over their own costs and could leverage on the asymmetry of information between buyer and seller. So the buyer, had to buy because of monopolies, because of lack of access to information. Today, we see a lot more symmetry in information, and which empowers the small business, but the platform players have the advantage. And so another thing I say in my book, which I need to deal with in order to get to where we're going, where we're heading with all this, is the role of the platform players going forward. And I'm suggesting that over time, the platform economy as been created from the 1990s up to today will start to disintegrate somewhat because individuals will have greater control over our own data. We decide who we want to relate to, and platform players will have to re-engineer how they, create critical mass in order to dominate transactions. Now, how that will evolve is not clear just now, and that will enable us to answer this question: what is the role of the intermediator going forward? In financial institutions, just have that very important role. They are intermediators of any transaction, any financial transaction, It's the traditional financial institutions losing that power that then creates a new ecosystem that we become familiar with. And of course, that power is accentuated by the fact that they are licensed institutions. In other words, regulators, give them permission to have the monopoly that they have, that other players don't have. So let's see how that evolves. I don't have an answer to that, but that's something that I put my finger on.
Okay. Yeah. No, it's fascinating to think about. You mentioned El Salvador earlier, their Bitcoin experiment. We haven't really followed up on that on this podcast in quite some time. Curious to get your take on whether or not you think that will succeed. What's going on with that? If you could expand a little bit on your opinion on Bitcoin as well, please.
So I visited El Salvador. I talked to people who live on Bitcoin. I asked them, with all the fluctuations taking place, how can you have so much faith in Bitcoin? And the answer is very simple, which is that if your liability side of your personal balance sheet, right, you make money, selling beer in Bitcoin Beach. If your rent is in Bitcoin, you have nothing to worry about, and it depends on what percentage of your liabilities are in the same currency that you're trading in. And I think that that gave me a glimpse of how acceptance of any form of currency eventually evolves. In other words, your bills must be in the same currency as your income. Now, of course, that's a controlled experiment. What's nice about El Salvador is that at the time it embraced Bitcoin, the IMF said that it was worried about the country's ability to meet its bond obligations. And earlier this year, they met their bond obligations. They had a $40 million, I think, that was coming due in January. They paid that. And that sort of created some credibility that this country knows what it's doing. The other thing that the country did was to create an ecosystem. So it's been trying to get ecosystem builders, software developers, and so on, to set up office in El Salvador. And so you get a little bit more in depth in terms of application development in Bitcoin. So, the application environment grows. However, the country is also building digital banking infrastructure. So Bitcoin is being developed even as its traditional banking system is going digital. And Bitcoin is only 2% of the total transactions. Actually, Bitcoin is as successful in El Salvador as CBDCs are successful in the Bahamas or, and several Caribbean countries, and even in China, which it hasn't even taken off, and in the Scandinavian countries where CBDCs have been launched, not just a pilot, but, being accepted. So this transition from traditional fiat currency to CBDCs or Bitcoin is not a given. The usage level has to be incentivized for it to increase. But as a country takes on more crypto into its balance sheet, the reality is not that it's able to meet its obligations, but it just creates an ecosystem that's an alternative economy as a whole. And then it has to generate its own income as it builds on that. So the answers may not be what we are hoping it'll turn out to be. It's not like if you have more Bitcoin on your national balance sheet that you'll be able to pay your bills in future. I actually see that the impact of technology on any form of economy is price destruction. It's not asset appreciation. And that's something about Bitcoin and cryptocurrencies that we need to, eventually come to terms with, that the value of cryptocurrencies is not that the price of Bitcoin is going to go up to 60,000 or 150,000. The value of cryptocurrencies is that it's going to be so commonplace that it becomes commodity in itself, that we use, but it doesn't carry any inherent value in itself. And that's something that we have to come to terms with. And the countries that are further down the road in embracing whether it's Bitcoin or any form of crypto as part of the economy, will be further down the road in terms of the depth of the economy and not necessarily the value of the asset itself. So it's a long game. It's not a short game, but the benefits are not that it'll be able to pay its debt obligations, and I think that's something that we need to come to terms with.
Yeah, it's just kind of fascinating to see where it's going, the potential of change. And it gives me a lot of hope for some of these problems that humanity's always had, but kind of shifting. And, thinking about some of the global issues when I was younger and in high school, I remember I had some teachers who were really trying to tell us that there was this China problem, those books that people would read back in the late 90s and early 2000s. But after reading some of your work, I'm kind of starting to think, maybe that things have changed, or maybe they were not quite accurate before. So I was kind of interested to hear your take on two things really, the future of war in relation to finance, and then also the China problem, as they used to say,
Well, I spent a lot of time in China. I've been very grateful for the opportunity to watch this country progress since the year 2000. In 2001 was when China became part of the WTO. The first thing to put in perspective when you discuss China is to respect what it has what it has built, and know for a fact that what it has built is real. It's built infrastructure. It's raised the per capita GDP of its population. It's got great cities. They work and people are happy. Then you need to put that in perspective of where they were coming from and where they're going to. Where they were coming from was a period called the Cultural Revolution, where the country went into this darkest period. But it was exactly during that period that it stripped itself of a lot of its history, a lot of its culture. It simplified the country, and it made the people hungry. And that's what set the stage for what it eventually became. If you ask me to put my finger on the one thing that defines China-US relations, for example, right now, or the dichotomy between these two economies, very simply, it's the way in which the two economies deal with information. And when you ask me what is the basis of the fundamental asset in the finance industry, I'll say to you that it's information. Actually, that's not even an original idea. That's what Walter Wriston said in 1969, that the asset in banking is information. It's not money. And then when you see, in this conversation, we're trying to, come up with a unified idea of economies and banking and the future of money. It's how these two economies deal with information. Actually, I'm very hopeful of the United States because it's a liberal economy. It's open about information, and because of that, it looks dysfunctional because of the openness with which it deals with information, and it empowers the individual to deal with information. Now, and China is just the opposite, which is it tries to control information. It tries to, shape it, project it, and utilize it for building a country. And so these are diametrically opposite approaches to information. And information is going to get increasingly ruthless as we go along. Things like ChatGPT automates the process of gathering information. So we're going to have more information than we ever had before. And it's how these two economies, putting them on two extremes, try to create societies that are able to handle information that we're looking at. That's the dichotomy that we're dealing with today, and and we try to judge one against the other. And always the control state may look very organized in dealing with information at some point, but there will be points at which it is unable to deal with information because its population has access to information. They can make decisions, and they might question authority. On the other hand, you have a society which has all the information in the world. Is so difficult to hold community together, and both societies will become stable after periods of intense turbulence, and there's a price to pay for intense turbulence. And I think the US has been paying that price, ahead of all other economies in the world. The rest of us will have to learn with how the US deals with, what happens to, January 6th, for example, and the fact that information is out there, and that different segments of population can respond to it in any which way they want. And on the other hand, in China, the initial reaction to the COVID crisis was to shut down entire cities of 30 million people, and then until they couldn't shut down anymore because people were pushing back against the state. So I think that's what we're dealing with, and the finance dimension in that is that I'm saying this in my book that the future of the world is the liberal access to information, and the financial token is what empowers the individual to be even more empowered than he ever was in history. The fact that you and I can exchange a token, the beauty of Bitcoin or cryptocurrency is not that Bitcoin went up to $60,000. It's that you can generate your own crypto. I can generate my own crypto. It's just 7 steps. It's, each of us can. But then the question is whether you would accept my token and I would accept your token. And that's why right now there are hundreds of tokens around the world trying to figure out what the governance structure that that's required to make them stable, make them interoperable, create liquidity and all of that. And so society goes through that process of trying to find the next plateau of stability with all that information out there in the marketplace, and we've seen this in the lead up to World War I, for example. The Industrial Revolution started in the UK, but the societies that were able to embrace it and benefit from it most of all were not the liberal societies. They were the highly organized societies. The Prussians, and they were, and the Japanese eventually. They were highly stable societies, but highly controlled societies. And there are points at which they look far more organized than the liberal society. So. And to say that one is a better answer than the other, well, that's a choice of where we live and the values that we have individually, and then we see humanity as a whole evolve over time, and the thing is this, that there are things that we need to appreciate about countries like China, but at the same time go back to first principles to understand where they're coming from. And then we'll be able to project what they'll look like going forward. And the other thing about China is this, that one of the reasons that the US can generate the amount of liquidity that it has through the Fed, buying treasury bonds and so on, has been that a lot of the inflation that otherwise would have been created in the U.S. economy was absorbed by countries like China. So the U.S. itself has been living on borrowed time, and it has been able to export its inflation over many, many years. But now China itself is becoming a high-cost country. And so, technically, if you look at it from a finance point of view, both countries, will have to redefine their roles going forward. So to sort of predicate that on the basis of a US-China economic war just completely misses the point of what the actual financial equation is.
A few things stuck out. ChatGPT, and then earlier about banking and the importance of information. Kind of curious if you could expand a little bit on how you think ChatGPT will affect the future of the global finance industry and what that might be for any individuals listening right now.
Studying ChatGPT, I run an information business, so I tell my employees to embrace ChatGPT, and ChatGPT, and open source. They are tools. They are productivity tools. They don't in themselves redefine humanity. They're no different than from the day when farmers had tractors and then combined harvesters and machinization and all of that. It just calls into question the laziness with which we've been able to live our lives, which is, that just by knowing a lot of information, we're one up on someone who doesn't know as much information as us. And that's the basis on which we do well in examinations and so on. So now the question is, how do we process information? And that's a function of intelligence that I think that AI hasn't been able to, make a breakthrough just yet. AI looks like it processes information, but it processes existing information. Even when we say it learns on existing information. It's up to the individual to imagine and create propositions that eventually become real or not real or get tested, and that's something that that will pit us one against the other, and I think that's where humanity will have to race to create superior societies, and where one society may well be superior to another. But having said that, we are also increasingly interdependent. The one story I always like to say is that the 777 aircraft that Boeing puts out is manufactured in 16 different countries. The iPhone on which we make our calls, it's made in several different countries. It's of course a lot of it is assembled in China, but the glass used to come from Japan. When Steve Jobs was looking for something that doesn't scratch and was light enough on the pocket. So something that the US has figured out is that it doesn't take a vested interest in original technology having to originate in the US. It's figured out that best practice comes from anywhere in the world, in the open world, and that's something that China is fighting against by saying that it wants to be self-sufficient in all of the leading technologies that the West is pushing back on, like silicon chip and so on. And I think that the more we emphasize originality, the more we emphasize interdependence, because no one person will be a purveyor of everything. I think that's when we are able to use something like ChatGPT to our advantage. ChatGPT itself does not give any person an advantage. And then you tie that into finance. It's really once again it's about finance being a carrier of information. That the asset in finance is information and how we process it. And so I just go a whole circle and come back to what my original point was, that because of tokenization, the individual is empowered, and then it's a question of how we organize society around that. It's difficult, but it can be rewarding. It's just that we have to give up a lot of the assumptions that we make about superior civilizations and stuff like that.
Yeah, very well said. I know we're getting close to the end of our time together. If there's anything I failed to mention that you'd like to talk about, or if you'd like to leave us with anything.
It's a nice, neat way to end this conversation is that it's an idea that I borrowed from a Rand Corporation analyst, sociologist who said that David Ronfeld is his name, and he said that human society has made a transition in 4 phases. We started by being tribal, and then we went on to becoming institutional, and then today we are mostly markets driven, which we are trading with each other a lot, and we're moving into a world which will be increasingly networked, and they're not individually, separate from each other. The tribal man became institutionalized, but he didn't lose his tribalness, and we see a lot of that in institutions, banks, which are made up of one nationality and stuff like that. And now we are in the market space. Everything that that Warren Buffett or Charlie Munger says about crypto is true, because they deal with what they see in the markets world. But what they don't know is what's going to be happening to money and crypto and technology in the networked world. In the markets world, you and I trade with each other. You sell me a token or a security or a mortgage, and I have to transact with you at the best possible price at that point in time, because once the transaction is over, you win, I lose. I win, you lose. We exchange something of value. You get what you want, and I get what I want. That's markets. In the network world, assets, especially digital assets, increase in value when you give it away, because when you give it away, you don't really ever give it away. If I give you a piece of information, I don't lose it, but I need to give it to 100 people for that asset, that information, to have any value. And so the rules are totally different. We're not there yet, but we're getting there. And that's why some assets, they increase in value the more you share them. Whereas in the markets world, it's a buyer-seller environment. So if we make sense of where exactly we are and what it is that we're dealing with, we are able to understand and explain what actually happened. So something I say in banking is that the LIBOR crisis, which a lot of people have forgotten now, but that was in the 2000s, in the early 2000s, where where traders were looking over the shoulders of the people who set the lending rates and said, can you tweak it for us? The lending rate people was a gentleman's agreement between the banks in the UK called LIBOR, the London Interbank exchange rate, or rather the interest rate. And the traders who are actually trading in the markets environment were looking for indices from the institutions that they could trade on. And so there was a transition, and that's why the title of my book is The Great Transition, the Personalization of Finance is Here, which is there was a transition from the institutional phase to the markets phase. So what I'm saying is also that as we now make the transition from the markets phase to the network phase, there will be all forms of fraudulent behavior because people who are following the rules of the markets and markets phase may not actually understand what the rules of the network phase will be as it's being created. So at every phase of transition, there will be confusion, and there will be the opportunity for fraud, for deception, and so on. And if we only conceptualize the transitions that we're making properly, I think we'll be able to understand it and also ace it and then project where it is that we are going.
Very well said. Where can people go to find your book and keep up to date with your next projects?
EmmanuelDaniel.com. That's where everything you need to know. My book is there, and also as the industry evolves, I'm responding to them. So the new stuff that I'm putting up on my blog page, and then from there it leads you to everywhere else.
Very good. Well, Emmanuel Daniel, I really enjoyed speaking with you. Thank you so much for sharing your wisdom and expertise with us here on the show. It's really, really enjoyable. Thank you for taking the time.
Ethan, thank you very much for the opportunity.